Perfect. Let's move on to the next session. So what are we going to do in this panel? We are going to be talking about the interconnected global economy. We've talked about it throughout the day, but we are going to focus on financial markets. And you've seen this again in all the presentations today, that financial markets don't just reflect macroeconomic shocks. They are actually places where shocks get transmitted, but also get amplified. And we are going to be discussing that through various mechanisms and channels. We have talked about interest rate differentials, foreign exchange pressures, trade flows, institutional responses. All of them essentially had propagation of shocks getting amplified through the financial markets, potentially affecting global outcomes. So what we are going to do is have three experts come in and talk about how these dynamics are evolving, unfolding in real time. So this is not going to be looking at data in the past. This is more about what's happening right now in terms of policy, how the market is reacting, and what's happening to portfolios and so on. So to do this, we have three experts. You can see who the panelists are. Hopefully you know. But we have HATZIUS from Goldman Sachs. We have Eric PARRADO HERRERA from IDB. And we have Jeffrey JAENSUBHAKIJ from GIC. And because our time is limited and we have a lot to cover, what we thought we would do is divide and conquer. So what I asked the panelists to do was to focus on a few things so that we can cover a range of themes, and then we'll have a moderated discussion. So each of the panelists will take about 6 to 7 minutes to talk about these different themes. And then in the moderated discussion, I'll probably dig into a few of these things in detail, and then we'll open it up for questions. So that's the plan. So with Jan, I asked him to focus, given the expertise, on the US economy, the financial conditions, the assessments of recent equity and Forex market moves, and how that's shaping global transmission. So he'll talk about that and other things. And I can tell you, given how his slides have changed within the whole day, it's really happening in real time. And he'll talk more about it. With Eric, I asked him to focus, among other things, on the recent tariff and trade disruptions on emerging markets, both the short and long run implications, and if he has any thoughts on how the emerging market policy responses should be given what's happening everywhere in the world. With Jeffrey, among other things, I asked him to focus on what the institutional investor lens on macroeconomic shock and market reactions might be, how the market is thinking about the evolving nature of safe assets, especially given what we have learned today about geopolitical and market shifts. So that's the plan. So what I will do now is ask each of the panelists, so starting with Jan, then Eric, and then Jeffrey, to spend about 6 to 7 minutes, talk about these themes, and then we will have a discussion and then questions from the floor. Okay, so let's get started. So Jan, did you want to come in and talk about the themes? Thanks.
Absolutely. Thank you. Wonderful to be here. Thank you for inviting me to this great conference. I'm going to focus on principle of comparative advantage, some of the topics that Amit just laid out, and a lot has been happening, of course, in terms of the global economy, in terms of our forecasts. The most recent change in our forecast was in a more positive direction, following the de-escalation between China and the US almost 2 weeks ago, which was more significant, a bigger drop in tariff rates, and came more quickly than we had anticipated. We modestly increased our 2025 US growth forecast from 0.5% to 1%. This is on a fourth quarter to fourth quarter basis. we took down our estimate of the probability of a recession over the next 12 months from 45% to 35%. And we made some smaller changes to our unemployment forecast, shaved the increase in the unemployment rate by a couple of tenths. So we're at 4.5% by the end of the year now. We also slightly shaved our forecast for where inflation is going to 3.6% for core PCE inflation from 3.8 previously. And then lastly, we pushed out the next cut in the federal funds rate from July to December. So we now only have one 25 basis point cut this year, followed by 2 more next year. So that was the latest directional change, but I think clearly we're still in a much weaker position than we were coming into the year. And you can see this here. You can also see that this is quite a different place for us relative to where we've been over the last several years, because we've generally taken a very optimistic view of the US and to a lesser extent, global economic outlook. But we do think that the escalation of the tariffs that are coming from the US, to a lesser degree, the retaliation against that are weighing on growth. We're estimating that tariffs are likely to shave between 1 and 1.5 percentage points from US growth over the next year or so. There are basically 3 channels that we think about in terms of the impact of tariffs on US growth. The tax-like impact of tariffs on real disposable income, therefore consumption. Tariff is a tax that cuts into income growth that weighs on consumption and GDP. Number 2, an increase in uncertainty about where the tariff regime and policy regime is ultimately going to land, which leads firms to delay investment and hiring decisions. And then third, potentially a tightening of financial conditions that weighs on consumption via negative wealth effect or on business investment via reduced credit availability. That part, of course, has changed quite a lot. We have seen a very substantial recovery in financial markets and a renewed easing in our financial conditions index. So if we look at where the impulse from financial conditions that we estimate via our financial conditions index, where that stood on April 8th and where it stands now, there's been a pretty big shift. On April 8th, we estimated that, assuming that level of equity prices and credit spreads, interest rates, and the trade-weighted dollar, financial conditions had the potential of subtracting, up to 1 percentage point from U.S. growth in subsequent quarters. Now that that negative impact has come down to, just 1/10 or 2. So that limits our estimate of the negative impulse to growth to something that doesn't look recessionary. However, I think the risk is that we could see renewed tightening in financial conditions, which would put you back to somewhere closer to a recession baseline. And there are 2 issues that I'm specifically concerned about. One, the tariff policy outlook remains extremely uncertain, despite the recent pullback from President Trump and the de-escalation vis-a-vis China. This is a time series of what we thought at various points in time since Election Day of how much the effective US tariff rate would increase in 2025. And while the most recent move has been downwards, there have been a lot of ups and downs that have shifted our views. I think there are upside risks, specifically in the reciprocal tariffs vis-a-vis Europe and other Asian economies as well. that could lead to renewed financial market shocks, renewed tightening of financial conditions. The other major issue, and perhaps an issue that's even more on investors' minds in recent weeks, even more than the tariffs, at least judging from the questions that I get when I travel around the world and speak with investors in different regions, is the US fiscal outlook. And of course, there's always a lot of detail around US fiscal policy discussions, and the bill, the big beautiful bill that's currently making its way through Congress. But I think if you step back, the real issue is that the US is running a 6% of GDP federal deficit and a 3% of GDP primary ex-interest federal deficit that looks like is going to be sustained for as long as the eye can see, which means that US fiscal policy remains on an unsustainable path. And that is something that increasingly is showing up in tighter financial conditions, at least in parts of the financial markets, and upward pressure on long-term interest rates. Now, lastly, I did want to look briefly at what's been going on in terms of our estimates for global growth, spillovers from the trade war into growth across the world through trade linkages and financial linkages. And these are the changes in our 2025 GDP forecasts since January 1st. And I just make three observations. One, the majority are negative. We've seen downgrades to a majority of economies. Most of the exceptions to this are more idiosyncratic outliers: Argentina, Turkey, Taiwan, on the back of the basically semiconductors. But in most cases, we've seen a downgrade. Number two, the US has seen a bigger downgrade than the other large economies, China or the euro area. In some cases, because of idiosyncratic factors too. In the euro area, we've seen a shift in fiscal policy out of Germany. But I think at the margin, I've been surprised at the relative resilience of the economic outlook in some of these large economies, both the euro area and to some degree China as well. And then lastly, some of the Southeast Asian economies in this region have been similarly hard hit in terms of the economic outlook as the US, with Thailand, Vietnam, and it's not in this chart, but Singapore basically seeing a downgrade to the growth outlook of about 1 percentage point since the beginning of the year. I will pause there and I think pass it over to Eric. Thank you.
Thank you very much, and hi everyone. It's a real pleasure to be here and share some ideas in 5 to 7 minutes about an easy topic, which is trade tensions and emerging markets. But first of all, I have to thank the organizers, MAS and NUS, for the invitation, and I'm really happy to be back, because my relationship with Singapore, it was since I was a young economist at the AMPF, and I wrote a paper characterizing the monetary policy in Singapore, which is pretty unique, and probably we can talk a little bit in the panel. So let's go to the presentation. I was talking with Amit yesterday, and he said, probably you may want to share slides. Okay, so I had to work yesterday night in this presentation, so bear with me, because I put some slides together, and I said, okay, let's try to find a picture to think about an analogy. And I asked ChatGPT, okay, give me an analogy. I invented an analogy, but give me the picture of this analogy. And this is the analogy of Hotel California. and trade. It's a little bit messy, but you understand the point. So, and the first idea is that we are living a Hotel California moment. Do you remember the lyrics of the Eagles? They say, you can check out anytime you like, but you can never leave. So an integration brings benefits during good times, but makes countries in some way hostage to global disruption during bad times. We were invited to integrate to the global chains, but now we don't have a say. So that's the complex issues that we are facing as emerging market economies. The nature of the current shock, and we have talked a lot during the day, but it's a self-inflicted shock. It's not like exogenous shock, like a COVID-19 shock or the 2009 financial crisis. So, but it generates a lot of uncertainty. And that uncertainty gets priced into exchange rates, credit risk, and investor sentiment. And it tightens financial conditions even before trade volumes are affected, okay? And more importantly, it has a huge impact on growth. For the US, I think, and there is a fundamental asymmetry, and we have to understand that. I know that there are many central bankers here, that for the US, tariff acts as a supply shock, driving stagflation, or the possibility to having stagflation, higher inflation and lower growth, while emerging markets primarily face demand shocks with growth slowdowns and complex price effects. And then emerging markets have really complex financial decisions and monetary policy decisions. And because higher US interest rate, it could imply capital flights. Then it has an impact on emerging markets currency volatility. And we have the discussion regarding it could be appreciation in the short term, depreciation in the medium term, depending on the channels. This is forced to stop policy easing despite weak growth. And of course, emerging markets, I'm thinking, for instance, Latin America, we have very high debt serving costs, and plus already high yields because of US Treasury levels, not because of risk premium. So that's a very complex environment where we have to take some decisions. This is just a summary of the tariff escalations. So a lot of going on every month, every day. So it's very difficult to pin down what is going to happen, but what we know for sure is uncertainty. Now we have a lot of uncertainty in financial markets, and you can see the tariff increase in China, so all the escalation, and then we go back to 55%, and then the majority of countries have a tariff increase of 10%. Okay, this is what's going on today. Why is it important? It's important for all emerging markets, but this is a stress test scenario for Latin America. And we have a baseline model where economic growth converges to 2%, which is our potential output. It's pretty low for any standard or any needs. But when we have the stress test, take a look to the different shocks. We have a China growth shock, we have a US growth shock, but you can see the most important shock is the US growth shock. So it can create, if the US has a recession, the Latin America can have a recession too. Okay, so that's why we care a lot about that. And moreover, our main trading partners are the US and China. And that's why we care a lot about this issue. We put together a trade model. It's a country model, many countries, many sectors. And the impact with the basic scenario is very important for all the countries in Latin America. Here we have other countries too. And you can see that the impacts are coming from 3% to 6% in terms of trade value, but it can go up to 10%. This is the impact on Latin American countries, but also, for instance, in China. But the most affected at the end of the day is the USA, which is an interesting idea that we can talk. Very important, an opportunity. Let's try to find opportunities here. One is FDI. So there is already a supply chain realignment, and this could be an opportunity for lag, and you can see that there is nearshoring flows going to some countries in Latin America. We have the examples of Brazil, Chile, and Mexico, vis-a-vis declines in China and other Asian countries. Another opportunity that is today a weakness is that very low interregional trade. In the case of Latin America, it's only 15%. Asia, 55%, Europe, 68%. So huge opportunity to try to find channels in terms of regional integration. So just to conclude, because I'm up with my 7 minutes, I think, never let a good crisis go to waste. Sometimes you do the reforms when you have a crisis. And I think it's an opportunity to say, okay, how to attract more foreign direct investment and how to integrate more to our regions or among regions. So here is the positive message to say, okay, we can do it and try to avoid the Hotel California moment. Thank you very much.
Thanks very much, and thank you to the organizers also for a wonderful day and this opportunity to share with you. You know, unlike Eric, who worked all night on his slides, I decided to have a good night instead. I checked into the Hotel California, asked the captain to bring me my glass of wine, and here I am. You know, as we think about the things that have happened, the news flow that has happened, we know that there has been at least one very big shock, right? The announcement of the US tariffs, retaliatory tariffs, and so on. And the financial markets have reacted. And financial markets initially reacted in a way that seemed to want to propagate that economic shock, right? So stock market went down, the financial conditions that Goldman measures deteriorated, and that actually makes the crisis worse. And but then actually it's fully recovered. Actually, even in Asia and in Europe, stock prices have pretty much recovered to where they were. Financial conditions are looser than they were before. And in a sense, the financial system did not propagate the shock. If anything, it provided an offset to the shock. So I think a question I wanted to just quickly address is, how do you tell when financial conditions are going to propagate a shock versus actually offset the shock? And I think there are three things that I like to think about when considering this question. I call them the three Ps. One is impulse. What is the original shock, and what kind of things does it lead to in the economy and in the financial markets? The second is, what is the positioning in the financial markets? Because the positioning could determine how large a price movement you get in financial markets relative to the size of the shock. And then the last is really, what does the financial markets anticipate in terms of policy reaction? Because sometimes anticipating a positive policy reaction could just completely change the dynamics of the financial markets and offset the tightening of financial conditions that otherwise would occur. So in terms of impulse, it's very clear that the type of financial shock could have differential impacts on different financial assets. So let's take the tariff shock again. Tariffs clearly are negative for growth, and so you'd expect actually slower growth as a result, maybe higher inflation because it's a supply shock. Both of these are negative for the equity markets. So you would expect the equity markets to go down, increase the cost of capital, and therefore tighten monetary conditions. On the other hand, slower growth should be better for bond yields, right? Just reflecting the slower growth. Maybe made worse by the fact of higher inflation, but actually it's pretty difficult to tell. And if bond yields were actually to contract, it then acts as a positive for the equity markets, and so it offsets, again, a little bit of that financial impulse. So I think every shock is different, and certainly within the financial investment industry, you have to think through exactly how the markets are going to react to that shock, even though it looks negative at the outset. The second piece, positioning, then becomes really important because it depends on how people are already positioned relative to the direction of the shock and where the price movements might be. So you've always heard financial market participants say something to the effect of, oh, this is already overbought. And so, whatever positive shock you have, it's not going to affect the price very much. Of course, that's nonsense, right? Because there's no such thing as overbought. Every buyer must have a seller, so somebody must have sold, and so on. But it does matter who is able to buy, who is able to sell at any moment in time. Because market prices are not determined by the exact crossing of every demand and supply curve in the market, but only by those who happen to need to come to the market at any point in time. And so whoever needs to transact actually determines the marginal price. And so the positioning then becomes very important in trying to figure out whether, when an economic shock occurs, the financial markets are primed to propagate that shock or actually not propagate it. And so, usually we'll think of who are the people who are fast money, who can't hold on to their positions very long and therefore may need to sell because the economic shock comes. So, hedge funds, we'll look at the hedge fund positioning, we'll look at CTAs because they also have to deal very quickly, and that becomes very important. For the other bulk of the participants in the market, they can actually come in and step in as liquidity providers and offset the initial shock and so on. But I think the key thing, particularly for policymakers, is you have to ask who is leveraged at that point in time, and are they at a tipping point at which their lenders tell them you have to liquidate in order to meet margin calls and so on. So the level of liquidity of the marginal players becomes very important. Now, what has happened since the tariff cut is that all the people whom you normally expect to have to sell actually did start to sell. They sold at the beginning, they sold in volume, hedge funds were kind of record net lows, CTAs were relatively record net shorts, but the retail investor actually in the US was able to come in. And in the month of April, they actually were the main buyers. There were also corporate buybacks. The blackout period had just ended and corporates had already pre-authorized a fair amount of buybacks. So that group was able to come in and actually completely offset the positioning that was already stretched of the other players. And so positioning becomes quite important. Then the last is clearly around policy, because financial markets try to price in the future. And so part of this would be the thinking around what is the endogenous policy response that is likely to happen. And I think in the case of many times, you've heard that the Fed put is part of the reason why financial conditions never tighten. Because every time they start to tighten, the anticipation is that the Fed would come in, lower interest rates, provide liquidity support, and therefore financial conditions don't tighten. This time round, it was very clear that the Fed probably would stay on hold for a while. So what is it that actually prompted retail to come in? What was the policy reaction? Well, I think retail have anticipated for some time that Trump and the Trump administration are very sensitive to the stock market. And of course, Besant had to come out, Trump also had to come out and say, oh, I don't really care about that. But the real test was at the 20% mark. And when it hit 20%, indeed, Trump capitulated, extended the tariffs, and so on and so forth. And so, if you will, the retail were proven right in terms of their anticipation. So I think as we think about these three things, what is the impulse that we're seeing? What impact should it have? The positioning in the markets, and also what is the expected endogenous policy response? I think it can help us to understand whether or not an economic shock is going to be propagated by the financial markets or in fact actually negated by it. I want to spend just maybe one last minute on safe assets. And I think safe assets are incredibly important. And the reason why they're perceived to be in short supply is because they're actually used as the collateral, to back borrowing and so on within the system, which allows other people to take more risk, right? And so the more safe assets you have, in essence, actually, ultimately, you can have more leverage within the system. But safe assets, I'd just like to make a few points. The thing is that they're really not safe if they are misvalued, right? And you just need to think of the 2021 period when bond yields were 50 basis points in the US, negative whatever in Europe and Japan. These were so grossly misvalued that there was only one direction in which they could go, which is down in price. That means they're not a safe asset. And so as we think about the kind of the prospects for safe assets, and as investors, including sovereign wealth funds, think about how much of the safe assets they should have, a real key consideration is how safe are they? And I think there are three dimensions in which you can think about safety of a safe asset, let's say US Treasuries. First is there any credit risk to it, right? And credit risk is all to do with financial, with fiscal deficits, whether they're on an an undeniable trajectory downwards, so on and so forth. And that becomes very important. And historically, up until now, most safe assets didn't have that problem. The second is whether there's interest rate risk. Now, that's clearly very, very much tied to that first one, the credit risk. But not only to that, because sometimes there are inflation shocks that come in that cause interest rate changes and therefore hurts, if you will, the value of the safe asset. And so the direction of inflation, what causes it, and what governments have to do to offset it becomes a key consideration. And I think we've all said that tariffs are inflationary, so that's a real risk again at this point in time. Then finally, the stability of currency risk is also important, right? There's no point holding a foreign safe asset if its exchange rate against your local currency, which you have to spend in, is ultimately on the way down. And so I think that is actually what has happened in the period since the Liberation Day, is that it wasn't just Liberation Day talking about tariffs, but the US government has also shown a propensity in the last 6 weeks to increase the fiscal deficit, adding more risk. And they've also talked incessantly about, I want a strong dollar, but it's not really a number, and by the way, in all the discussions that they have with their allies, they're talking about, what about weakening our currency against yours? So I think the fact that all these three risks are now put in play by the administration, makes the issue of safe assets and whether US Treasuries are really a safe asset something that is an issue in the mind of investors. And that is why I think, Professor Ray's charts about why post-Liberation Day the reaction function has been so different is because there has been a signal specifically about exchange rates and about US assets. Thank you.
Let's get started. That was extraordinary. We all kept on time, which I must say is a good thing. That allows us to have more discussion. Did any of you want to respond to anything that you said, or you all agree with what was mentioned by all of you? If not, then I'll have a few questions that I want to raise. Anybody want to say it? Okay, so let me ask something. So this has been bothering me, but it was raised in Jeffrey's comments. Like when we look at equity markets or any markets, it seems like all the uncertainty, all the stuff that's been happening, seems the markets are looking past it. So is it because these things don't matter? Or are the markets mispricing this? And if they are mispricing this, what should we be looking at? Are there some markets where maybe we see these things better priced? Because we've seen this in many talks yesterday and today, that if you look at indicators of uncertainty, for example, they have spiked to levels we have never seen before. Clearly, markets should be forward-looking and thinking through what it does to investments. And I'm not even talking about all other kinds of policies. So how are you all thinking about this? Is this just temporary? Are the markets mispricing this, or what? Anybody?
I'd love to hear the Goldman view first.
Yes.
I do think markets have been taking, a very upbeat view over the last several weeks on the back of some of the capitulations and the backtracking, and I think there is a view that has sort of taken hold in markets that the direction is now sideways or down in terms of the tariff risk. I think it was on Liberation Day or shortly after that the Treasury Secretary said we now know the peak, and from here on it gets better. And of course that has been the case, certainly in terms of our projections since then. But I think there is an argument that we have now potentially exhausted the supply of good news on the on tariffs. I think there is a significant risk that we'll get renewed escalation or renewed threats of increases, especially as far as the sort of second stage of these reciprocal tariffs is concerned. And so I do think when our team looks at what markets, what sort of economic scenario markets are now priced to, it's similar to our baseline case, maybe a little bit better than our baseline case, but certainly not putting much weight on the downside case. And I would still say, 35% probability of a US recession, that's still a pretty high number. A normal sort of average number is about 15% because we've had a recession about once every 7 years. So I do think that markets are maybe taking an excessively rosy view of things at the moment.
Yeah, I think I'd agree with that. There is a Warren Buffett line that says in the short term, the market is a voting machine, and then in the long run, it's a weighing machine. And in the short run, it's basically reacted to who wants to come to the market to buy. And I mentioned retail and so on. And so to have prices, equity prices back at Liberation Day levels, even though even in the best case, that you don't get the full extent of tariffs, news has worsened. It just tells you that the market doesn't reflect the long-term implications of that news. And I think the likelihood is that over time it will have to react, and then it will come down to that level.
Let me say something. These guys are the financial experts, so believe them. But I want to say something. I'm trying to find an analogy. So, for instance, when inflation raises 1 month, and you take a look to the CPI inflation, and you can see that it raises because the price of lemons increase. And then you have like a reaction to say, okay, the central bank should react before the price of lemons. And we know that this is not the case. And the equity market is doing more or less the same. They're trying to find like good news to react in a positive way. But I think if you take a look, a medium-term look, probably is more on the negative side rather than the positive side. So I think we should avoid to read a lot of noise and try to say, okay, what is going to happen in the medium term? And that's why it's important, what are the economic projections regarding GDP growth and, of course, inflation.
Do any of you want to, or all of you want to talk a little bit more about US as the epicenter of financial propagation? We've talked about dollar's role as a reserve currency, but has it become, instead of being a stabilizer, a source of volatility? And how are the markets thinking about it, and how are emerging markets thinking about it?
There's an interesting contrast, and again, I think Professor Ray's presentation showed it a little bit, which is that in the GFC, where the US was the source of problems, in the end, the dollar still and dollar assets still remained a safe haven.
Yep.
And so I think the fact that it's not acting as a safe haven this time round, there is a qualitative difference. And the question is, what is that qualitative difference? Is it the uncertainty in policy making that is come into play? Is it the fact that they are talking about deficits as long as the eye can see, that you finally reached a tipping point around credit risk for the US, and you know that US CDSs are as high as they've ever been, or is it that they've now started to put the dollar into play? And I think that's a qualitative difference from the GFC period, even though the center of the economic propagation is the US.
Yeah, I mean, I've always been impressed by the extent to which the U.S. is and the dollar is entrenched as the dominant currency, and I think some of the charts that Pierre-Olivier showed earlier are quite impressive in that in that regard. So I do think it would take a lot to upend the dollar's position. With that said, even if if the U.S. remains the dominant currency, the dollar remains the dominant currency, I think you can make a pretty good case for why the dollar is likely to depreciate over time. You don't need to make any, particularly aggressive arguments or assumptions about that. The dollar is very, very highly valued, 2 standard deviations above the long-term average going back to the early 1970s. The United States is running a 4% of GDP current account deficit, and in an environment in which US economic outperformance is no longer as pronounced as it's been for many years, I think there is a strong argument that it'll be more difficult to attract enough capital inflows to cover the current account deficit without some valuation adjustment, most naturally via the exchange rate. So we do think that we'll see dollar depreciation in coming years.
Eric, I'll come to you in a second on emerging markets, but let me just follow up with you, Jeffrey, if you don't mind, because you raised the issue of safe haven. So how do institutional investors think about what's safe in today's environment, given all the things that we are talking about?
I think all investors look to past history as the guide, and so there's a convention that occurs that historically this has been a safe haven, and therefore you expect it to be a safe haven again. And even more impressively is that if you think other institutions think it's going to be a safe haven and that's what they're going to go to, then that's what you also want to go to. And I think that is part of the reason why dollar as a reserve currency is kept its safe haven status so well. Interestingly, some of the other safe haven currencies acted well in the last few weeks. So the Swiss franc, even the yen for a period anyway, Singapore dollar. So some of those I think would naturally gain that. But it is a problem when dollar assets are not the safe haven, because really by contrast, everything else has normally has higher credit risk or higher currency risk, and I think that is causing a bit of a problem. Gold has become a little bit of a safe haven, and I think that there are more people who are now thinking of that really does make sense.
So let me say something, because probably the experience is useful. I used to be the manager of the Chilean sovereign wealth funds, so I have a lot of discussion with JIC and Temasek, and this was before the global financial crisis, and we invested only in AAA countries, tried to find very safe assets, very liquid portfolio, deposits in banks, and so on. So when the global financial crisis came, we have bonds from Portugal, Italy, Ireland, Greece, Spain, AAA countries. And then we were working with the central bank as the asset manager, and I called them and said, you know what, it would be a really good idea if you can sell these bonds. Impossible. They couldn't sell them. And we were lucky because it was very short term. So we have to spend waiting for 1 month or 2 months, and then we get paid. But and this is the issue of your previous question regarding the pricing of this type of asset classes, that we have to be careful. And in crisis, we have to be especially careful.
Okay, let me continue on that, because I was going to ask you something about emerging markets. You talked about Hotel California. One of the things that you're seeing is, as trade shocks are hitting, there is a lot of political response, a lot of discussion around protectionism. So what's your thinking about how emerging markets should try to not get caught in this spiral and be more resilient? What can they do?
I think we have to avoid protectionism, and we have to build bridges and not walls. And I think that's important, that we have to keep that in mind, because the benefits of global integration, are huge. So we had a recent flagship that tackled the issue, and we found that the most successful economic policy is integration in terms of the impact on GDP per capita. So I think it's a good idea to think ways to avoid the impact. And that's why in my presentation I said, okay, we have to focus on regional integration. For Latin American and the Caribbean countries is a huge opportunity, but also for other emerging market regions. Sometimes, for instance, there are resources in Asia, in the Middle East. We have really good ideas, but not too much resources, and we have to join forces to have a win-win situation for us.
Okay, so I'm getting close to the last two things that I wanted to chat. So if the audience wants to think of questions, please do so now. You know, Jan, you had this slide because I have the benefit of knowing that you had this slide on central bank independence, and then something happened in the US, so you removed it. But I think the issue still remains, obviously. And, you know, we had this discussion yesterday over dinner in Raghu's discussion as well, that there is a whole political angle to it. That angle has not gone away. So what do you see as risks to independence? And others, please chime in also on not just US, but around the world, because it matters.
7 minutes was a binding constraint.
Yes.
And so I removed one slide that looked at basically the legal position of the FOMC and the Fed chair relative to the governors of other G20 central banks. And the concern that we've been pretty vocal about over the past several months has been that there was a possibility of the Supreme Court basically removing for-cause firing protections from Jay Powell and the Fed chair and other FOMC members. The decision by the Supreme Court overnight to basically shield the Federal Reserve and declare the Federal Reserve special relative to other federal agencies, I think lowers that risk quite a bit. So I'm less concerned about the Fed becoming, you know, less independent than other G10 central banks and more like the central banks of China, Russia, or Saudi Arabia, which I think was a real risk, or would be a real risk in a situation in which the president was able to get rid of the Fed chair, even without malfeasance or neglect of duty.
Yeah, for now.
For now, but if this is the Supreme Court, you know, the Supreme Court's position, then it would take quite a lot to you know, put you in a position where the Fed chair really can be removed. And so I think, and you know, I'm not a lawyer, but I think at least some of the lawyers that I consulted on with this agree that this is a pretty important decision.
Yep. Jeffrey, Eric, any thoughts on this?
Yeah, no, just one quick thought. I loved Professor Rajan's comment that, you know, also central banks ultimately need to have some political backing. And unfortunately, even those with a single mandate, you know, the state of the economy, state of unemployment is not something that they can ignore. And so I think the risk is not just the direct independence of the central banks and being pressured by governments to kind of monetize their debt and so on. But it's also when there is perceived pressure that you need to keep employment high if possible, and ending up, you know, overstimulating the economy or keeping rates so low that imbalances get built up that eventually result in problems. And I think it's the rare central banker who can sit through all of that pressure, if you will, on the whole economy and not just inflation, and not overstimulate, if you will.
Probably I can add that independence of central banks is an asset, so we have to defend that, because if you take a look to the previous research to say, okay, what is the inflation in average, is much lower in the case of countries with independent central bank, which is important. And also very important that they avoid the short political cycles. For instance, in Latin America, the political cycles is 4 years, 5 years, and the term of the members of the boards usually is 10 years or 8 years. So that's very important to have a long-term view of things. Having said that, for instance, they have to be very coordinated with fiscal policy. So I think it's important that the coordination, because you need the political backup in some way or another. And third point that I want to make, I wrote a project syndicate op-ed saying that the central bank like idea probably is a good idea for other structural issues. I'm thinking about infrastructure. Why infrastructure is a competition among politicians? Why? Why pensions is a competition among political parties? Why education is an issue? Why health is an issue? Probably we can agree and have like a technical view regarding these topics and have a long-term view, not for the next 2 years, but for the next 20 years.
Okay, one last thing. If you were to pick a weak link that we haven't talked about as much, what would that be? We've seen market structure for assets. The asset holdings are very concentrated, at least in the US, I'm guessing around the world. There's been a huge growth in shadow banks, non-banks, private credit, huge amount of liquidity floating around. What do you see as the weak link? Anything that comes to mind?
I think one of the good things is that banks in general have been better capitalized, better regulated, since the GFC, and the banking system as the transmission mechanism of a lot of these problems, hopefully isn't as risky as before. But the one thing I do worry about is how much of the carry trade has gone on, and how much of that has helped the dollar kind of appreciate up until February and so on. And if that needs to unwind in any way, either because the dollar starts to fall in value and those who have the carry trade on, even if they've hedged, the people who hedged them have to react to that. So that could undo a lot. And I think the global financial system depends on that carry trade to fund a lot of things. I don't know.
This is less financial and more fiscal, but I mean, for me, really the structural imbalance between revenues and outlays in the US. I mean, the way I like to think about it is that there used to be kind of two models for fiscal policy: the US model, which was low spending and low taxes, and the European model, which was high spending and high taxes. And over time, on the outlay side, the US has become a little bit more like Europe. There's more government provision of healthcare. There are other structural drivers of higher spending. So outlays as a share of GDP have been on this pretty steady upward trend, but revenues as a share of GDP have been basically dead flat for decades for federal, 17 or 18% of GDP. And there's no real prospect of raising outlays to the sorts of levels that can finance raising revenues to levels that are consistent with the increase in outlays. And so that until some kind of solution is found for that, I think that's a big risk for the global economy and global financial markets.
I mean, part of it is showing up in the financial markets, as you know, with the bond yields and so on.
Yeah, and I think there's obviously more focus on it, but it doesn't. We haven't seen anything that would be close to what's probably needed to bring about a significant shift in policy. At least I'm not seeing it.
No, similar to Jan, I would say fiscal policy is an issue everywhere, advanced economies and also maybe market economies. And the problem is that we did a really good job in terms of reacting before the global financial crisis, increasing deficits, increasing debt, but we haven't done a good job now. So we need to start a fiscal consolidation process, which will take some time. So that's, I think, one of the weakest links of our economies.
So that's great. Okay, so we have a few questions. So why don't we start there? If you can get a mic there. And maybe another mic can come to...
Hi, thank you very much for your presentation. Just a quick, this is a question more about emerging markets. I mean, we talk about the trade shock being very bad for EM, but in terms of the propagation of the financial shock to EM, what is quite unique in this cycle is as we had the shock, usually the shock that amplifies the EM is that the dollar ends up strengthening. But precisely because we had this shock, but actually the dollar weakened, to, in essence, the spillover in EM and the tightening didn't really materialize as much as expected. It actually created a lot more space. And maybe it's a reflection of what was earlier mentioned about we were going into this period for several years of very low positioning in EM relative to obviously what's happened in DM. A similar phenomenon also happened with term premium. Normally in the past, we always think another propagator of financial shock into EM is that just like what happened in taper tantrum or even post-GFC, this very strong correlation between US term premium and the spillover to long duration bonds in EM. And it's really interesting. We see all this fiscal blow up in the US. We see JGB yields blowing up, bond yields blowing up. Okay, with the exception of idiosyncratic risks in Colombia or Romania, for the most part, term premium across EM local yields have been extremely well behaved, even in the likes of Brazil, Mexico, but if you look across Asia fixed income. And so the other question I also want to ask, I mean, I guess we're also in a world of trying to think of an alternative safe asset, right? I mean, of course, in a world of second best options, none of it is really perfect. And you mentioned, things like credit risk, inflation risk. There's not really any inflation risk in fixed income in Asia, given how low inflation is. Everyone's been so very fiscally conservative. And I'm just curious, when you look at, we've had many shocks now. We've had the pandemic shock, we've had the Russia-Ukraine. If you look at total returns, both on FX and duration adjusted basis, all across a lot of Asia fixed income, including parts of EM, especially on a Sharpe ratio basis, we actually outperform US Treasuries. So I'm just wondering, are we in this kind of paradigm shift where, like DM's behaving like EM and parts of EM's kind of behaving like DM, and in a secular change in view in the dollar, should we, and the changing relationship and the inverse correlation sometimes between the term premium and EM and what's happening with the dollar, is it plausible to say, we may worry so much about the trade side, but there's something about the financial transmission that's somewhat changed?
Let's take another question, and then you all can answer both of them. Thank you.
So it will actually go back to some of his points, and that's mostly for Jeffrey. So Jeffrey, when you talked about the safe assets, you came up with 3 characteristics. Right? One was the credit risk, the inflation risk. The third one was the currency risk, right? But to my surprise, you didn't mention anything related to liquidity of markets, breadth of market, the ecosystem around that safe asset, etc. So because if these were only these 3 characteristics, I mean, as was pointed out, right, and to some extent, or you could actually manipulate you choose your safe asset. I mean, then, the euro being a big trading partner, yeah, you could decide to fix your exchange rate a little bit more towards the euro rather than the dollar. And that would give you, essentially, thinking about the German Bund or other things, these 3 characteristics. Now, there seems to be something else missing, or is it that you have in mind a safe asset tailored, for each individual country that can fix currency, or do we need something which is a little bit more, everyone having a common safe asset and liquidity associated to that? If you could elaborate, would be great.
No, I think maybe just answering Porfiray's question first. I mean, I think you're right that ultimately, no safe asset can be a safe asset for many people if the liquidity is very low and so on. So those 3 characteristics are necessary, but not sufficient. And as I mentioned, unfortunately, convention takes a long time to switch. And so, whereas I think in the early 2000s, actually the euro was starting to gain a lot of momentum around that. But has subsequently lost a lot of that momentum in the last 15 years. I think it will take 2 or 3 years to gain that back. Actually, China government bonds have been reacting really well. The currency has been in a tight band. But how many people are allowed to put money in China as their safe assets? Well, a tiny minority. So I think financial markets trade in conventions because you need someone to sell it to, so you want someone else to also be willing to hold it. So I think these things take time to change.
Any response to the first question? DMs behaving like EMs, and what's safe asset?
Probably they are related because I really, these discussions are really long in terms of trying to find the best asset classes or the safest asset classes, and at the end of the day, you ended up with the U.S. Treasuries, and that's why it's because we have the most liquid markets, and because the scale. So the portfolios of any fund, any stabilization fund, it has more than 50% in dollars. So it's very extremely difficult to find other type of safe assets to replace. Not in a year, not in 2 years. It's extremely difficult. So I think liquidity is a key component, as Professor already mentioned.
Jan, anything? Any other questions from the floor?
Thank you. Hi. I guess in the spirit of introducing myself, I should say I'm Taimur Beg. I work for DBS Bank in Singapore. Pierre-Olivier, the book is called 3 Days in Camp David. It's Yale's Jeffrey Gartens who's written the book. Those of you who are not familiar with the 1971 episode, I highly recommend reading the book. Some of the parallels are absolutely uncanny. My question is on dollar weaponization. Sitting here in Singapore, we're very worried that not only are we going to see demands for appreciation of currencies against the US dollar, but if you see the Lutnick, Besant, and Moran's sort of, talks in the recent months, it seems like, secondary sanctions on countries that might be adjacent to China, or, widespread export controls. We saw last week on Ascent chip coming from Huawei that anywhere in the world, somebody using it is subject to export controls. So how far do we see this weaponization of the dollar going?
And one last question, go for it.
Yes, thank you very much. My question is linked to also the profitability of the assets. So as investors, you obviously look at the profitability of assets, and for USD, it's actually also a very important aspect of it, right? Because especially because also I'm European, and that's something that we're seeing in Europe. Our savings somehow is going to the US, not because it's safer or, we also have the FX risk, just because it's more profitable in a sense. So how do you see this holding the role of the USD as the safe asset or the main, right? The main currency in the system? Thank you.
All right. Please respond to these questions and also any final remarks.
I mean, the profitability in the US is higher. Return on equity for US companies is higher. Price to book for US companies is also higher. So there's an equilibrium there, I think. And you can certainly make the argument that the higher profitability is, more than accounted for in equity valuations, but it's clearly an incredibly important factor if you plot price to book against ROE. Across countries, there's a very close relationship, as you would expect. But yeah, the question is always, are you underpaying for this or are you overpaying for this? And I don't think you're at the moment, if you look across markets, and I'd be interested in Jeffrey's view, but I don't think you're underpaying for that higher profitability.
There is a chart that says that outside of a very small group of U.S. companies, actually the earnings growth or profitability growth in Europe has been that bad, has been more or less the same. And I think, we tend to think in macro terms, but there are important technology-driven sector and comparative advantage shifts that have taken place in the last 10 years that have really benefited these American companies. That Facebook doesn't dominate social media in the U.S. as a technology company alone. It dominates advertising. It's taken up the advertising sector's profit share, but not only in the U.S. It's also the social media of choice in Europe. It's also the advertising medium of choice in Europe. So as a result, actually, the US has been taking US companies have been taking market share in the global economy. And I think that the question is, on a go-forward basis, do those same companies dominate new additional industries? Are the US AI companies going to take some of that dominance, but still be US? I think those are important questions. And you know, it is linked to the dollar, because as they have taken share, people have wanted to bring their money into the US to buy those assets, and that helps the dollar, and it's a positive virtuous cycle. If the cycle breaks because of the dollar, the cycle breaks because profitability actually changes, it comes the other way. And so I think these are as yet unproven, and the bias of most investors today is to say US is exceptional from that point of view, and it's Europe or China's onus is on them to prove the investors wrong.
Eric, any last comments?
The last comments of the panel?
Yes, last comments of the panel.
No, probably let's try to take this crisis and as an opportunity in some way to do the reforms, to defend central bank independence, to have a consolidation process on the fiscal accounts, and also one issue that my colleagues mentioned is the importance of having very solid and liquid banking systems. I think that's important. It's a given, but I think when crises come, I think it's important to have a very solvent banking system.
Okay, so thanks to the organizers for putting this incredible panel, and the panelists for doing an incredible job. I'm not sure I feel optimistic or pessimistic of where we are going, but I guess that's where we are. That's where markets are. So with that, let's thank the panelists, and I think we are on for a break.